So this presentation is going to be a technical presentation for all of those who are non-technical, and by non-technical, I mean non-programmers such as myself, and a practical presentation as well for both of those who are technical and non-technical. And the idea is to show a view on what Web3 is, what all of its main use cases and main components today and in the future, and also what are the practical, economical, and legal consequences today, and also that may occur in the near future as well. I have divided the presentation into three main parts, the first of which, and the first 2 seconds, very brief ones. The first, why we are here today. The second one, the differences between Web 1, Web 2, and Web 3. And the third, the Web 3 and all of its components. Now, why? Why are we here today discussing about Web 3? And to put that into perspective, I'd like to ask you, what were you doing in 1995? Did you use a lot the internet? Were you online that much, texting, using messages, trading photos, or even working? Or your clients, your companies use the computer a lot? I really believe that not that much, as in 1995, only 30 million users, the internet had only 30 million users. And if we were to compare the crypto industry today with the internet, it would be as if we were still around 1995. We were to compare NFTs when only 30 million people use the internet, and nowadays there are only 30 million using NFTs. And we would be in 1997 if we were to compare with Bitcoin, that has recently reached the mark of 130 million US dollars. But you also may ask, okay, I agree with that, Bernardo, but today, me as a lawyer, I don't work 24/7 on technical internet issues, so why would I need to learn about Web3 technicalities and so forth? And there are several reasons for that. The first one is the added complexity that Web3 brings to the players involved, as well as to those who are assisting those players, such as lawyers and so forth. And this complexity occurs mainly due to the decentralization, which removes the trust in a third-centered party, such as Facebook, Google, Instagram, and so on. And it brings a need for the players to have more technical knowledge on whatever it is that they are exchanging. Not only that, but also there is quite an added potential to the capabilities of Web3. And what I mean by that is the following. The internet has changed all of our lives, indeed. But those who directly profited out of it were the tech companies. And internet, indeed, has become mainstream, and many companies have hired the big tech services, but they don't run on the internet itself, and they don't depend on the internet itself necessarily, and they don't reflect necessarily on the market cap of the internet. Contrarily, Web3 has the capability of surpassing a lot the market cap of big techs. And I don't mean that, oh, because Bitcoin is going to be worth 100 trillion US dollars as a store of value or investment. Perhaps, but not only that, but because every single one of these companies will one day be on a blockchain and be traded as a cryptocurrency instead of being exchanged on the NASDAQ or S&P 500. Furthermore, and this is to put also into perspective, this graph is actually quite outdated. Values are around double or triple that, but the debentures and bonds market is around 400 billion US dollars, futures market 700 billion US dollars, and global market around 1.5 to 2 quadrillion US dollars. And the estimates are that one day all of that will be crypto. And there's also the added impact to it. And by impact, I mean, if I were telling you in the 1990s how life would be today using Zoom, Instagram, and so forth, that will be a serious advantage for all of us on what professional and personal life are concerned. And this impact will actually happen much faster than the impact that the internet itself had on us. And that is due to the fact that the adoption rate of crypto and NFTs is much, much greater. The internet had the fastest adoption rate so far. There was around 69% a year. Bitcoin is currently with an adoption rate of over 120% a year. That's not exactly double, but much more, as it is an exponential rate. And the last year's estimate was that it would reach 1 billion users in 2025. However, the growth is so fast that these estimates are now around 2023 and 2024. And the internet only achieved the 1 billion user mark in 2005. Now, what are the differences between Web 1, Web 2, and Web 3? Celestino has already addressed this issue in a very recent article, and I'll pretty much explain what he said and what is the difference are. Web 1 refers to the internet in which we only consumed content, read only. And it actually was a bit decentralized. Web 2 refers to the internet as we know it today. It began in the early 2000s and continues and will continue in following years as well. And it refers to the internet in which we not only read content and consume content, but we also create content and we monetize on that. However, all of that happens in a centralized manner. We trust and we depend on the big techs such as Facebook, Google, Amazon, Apple, and Microsoft to exchange the values between us and on big banks and so forth. Now, Web3. Web3 refers to the internet in which we connect our wallets. I, on the one side, connect my wallet, you, on the other, connect yours, and you exchange directly without intermediaries. And this somewhat subtle change will bring so many impacts and changes to our lives that we can only begin to grasp the magnitude of them. And to put that into perspective, I'd like to also make a comparison from before the internet to the internet. Before the internet and after the internet, we continued to do pretty much the same thing as we did before the internet came along. However, everything was amplified, online, virtual, 24/7, faster, and the reach was amplified, but pretty much the same things. And why things didn't change all that much? Because the power remained with the same people, with the same governments, with the same companies. And the control remained with them. Why? Because we gave them power. We gave them control. Why? Because we trust them. Now, Web3 comes along. Web3 refers to the means of living in which there is no need for trust. Rather, we rely on cryptographic proof. And therefore, we take back control, we take back power, we cease giving money to big companies to make these changes for us, and we ourselves are the players on this decentralized world. And what is this Web3 decentralized world? Web3 encompasses all of these issues: crypto, DeFi, blockchain, NFTs, smart contracts, DAOs, dApps, games play to earn, and metaverse. And several of these interlap and interact within themselves. There is no ideal way to make a categorization, but this was the best one I found to make it easier to explain. And you may ask, why is metaverse last? Because it may encompass all of the above, or it may encompass none at all. So let's dive into the first topic, cryptocurrencies. What are cryptocurrencies? Cryptocurrencies, in essence, are a digital currency that lives on a blockchain, and it is traded in a decentralized manner. Now, a currency in itself has three requisites: to be a means of exchange, store of value, and unit of account. There is a whole discussion on whether or not cryptocurrencies, even if Bitcoin would comply with these three requisites, but this is not exactly the main topic of the discussion. And this is actually the definition that I gave, quite a general definition. And the reason for that is because there are several types of cryptocurrencies, and such as Bitcoin, which is a payment currency, blockchain platforms such as Ethereum, stable coins such as USDT, and utility tokens and CBDCs, which is another thing. Now, what is Bitcoin? Forget everything that you have ever heard before. Bitcoin is not a currency. Blockchain is not a database. Bitcoin is a platform of trust, which main application indeed is cryptocurrency. And as you may have realized in the keynote, there are two Bitcoins. The Bitcoin with capital B stands for the Bitcoin protocol or the Bitcoin network. And the Bitcoin with a lowercase b stands for the Bitcoin, the currency or cash. And what is Bitcoin? The cash. It is a digital currency or cash that is P2P, that is peer-to-peer, and it occurs in a decentralized manner in such a way that there is no trusted authority regulating what goes in there or doesn't, what is the interest rate, what is the supply. It is decentralized. It is considered to be trustless in the sense that there is no need to trust in this third party to regulate. That is also scarce, as there are only 21 million Bitcoin. Actually, it is a little bit less, 20,999,999 and 9 Bitcoin and 97,690,000 Satoshis. And Satoshi stands for one a fraction of Bitcoin, which is fractionalizable up until 8 digits. And it is also considered to be hack-proof in the sense that it is pretty much unhackable for reasons which we'll see later on, and anti-fragile. That means that whatever you throw at it, it will become stronger. So if the US were to ban Bitcoin, that would sincerely be the best thing that could happen to Bitcoin today. It may drop the market value of it, and it certainly would, but in the long term, it would really be the best thing that could happen for the market. Now, briefly, why was Bitcoin created? And this is quite important to understand, perhaps one of the main important aspects of this entire presentation, because it is something that will accompany us for the rest of our lives as Web3 comes along. And there are two main reasons. The first one was to serve as cash. Now, cash may not have an exact translation to every language, but it actually means paper money in the sense that we don't have cash in the bank, we have money in the bank, and we have cash in our pockets. And up until Bitcoin, there wasn't really a digital cash in which A could exchange with B without each party knowing the other party. So Bitcoin came along. The other reason was to serve as a free market currency that would not be interfered with by governments or big companies. And that is especially has any special significance within the 2007-2008 subprime crisis, which in essence occurred due to the fact that banks started lending money way too easily for people to buy mortgages, buy houses, and anyone, even those who were unemployed, could buy 3 or 4 houses. They were going to live in one and rent the other 3. Up until some time, some people didn't pay. The interest rates increased a little, and more people didn't pay their installments, and the US economy broke. And what did the US government do? They have the people? No, they have the banks. They printed over $700 billion to help the banks, and every single bank came out of it even richer than they were before. Only one broke, that is Lehman Brothers. And the people, well, everyone lost their houses, lost their jobs, and they lost their purchasing power, because due to the excessive money printing by the government, there was an inflation. And just to clarify how this money printing actually happened, It is not exactly or not necessarily printing money, but it occurs via quantitative easing. You may have heard this term before. It is really, really difficult to understand. It took me quite a while. And in essence, it means that instead of printing money, the government goes there and it clicks a button on the computer, and this button creates digital money, dollars, that are used to buy really bad bonds from big banks, such as bonds that the banks know, oh, these clients of mine, they are not going to pay. The government creates money to buy these bonds out of the banks, and the banks now have free cash that they can do something about it. They can invest or lend to the people and charge interest for it. And the money is slowly flushed with more money, and inflation occurs, but it tends to occur a little bit slowly than it would with outright printing money. Now, another thing to put into perspective, and I'll move briefly to these topics that they are more historical purposes, is the end of the gold pattern that happened in 1971 as President Richard Nixon ended the Bretton Woods Accord. Up until 1971, for those who didn't know, we could go to the US bank or some US institution and exchange our dollar per gold up until 71. After that, the dollar was stopped being pegged to gold, and the US started to print more and more money. And this graph shows the Fed money printer. So it started to print even more money. And you remember that I said that the US government printed 700 billion US dollars in 2008. This is only this on the graph. With COVID, it printed even more. That is why we are all around the globe suffering with inflation. And this is why this bank note of $100 shows the decrease in value of the US dollar. And finally, if you are not convinced that there is a great possibility of Bitcoin or some other cryptocurrency that may not have been created yet, surpassing the market cap value, the use of dollar, the dollar is only a global currency as of recently. It changes every now and then, and normally the greater the economy, it becomes the global currency. These are some graphs that I'll make available the PowerPoint later, then you can check. And also a graph about the history of money. It started all with commodities, then it went to metal, gold, silver, and bronze, and it only started being paper money in the 11th century in China, and it only started being in the US and Europe in the 17th century. And all of those paper money were actually certificates of gold ownership. And imagine back then, people, oh, I don't want a certificate, I want gold. And out of curiosity, when US banks started to recording transactions in computers, there were actually consumers that filed lawsuits against the banks because they wanted the banks to stop recording things on computers, and they wanted them to be recorded on ledgers, physical ledgers. So just a fun fact. Now, payment currencies. Bitcoin is one of type of payment currencies: XRP, Doge, Litecoin, Zcash, and Monero. These last two, Zcash and Monero, are actually more anonymous, as they use zero knowledge proof, which is a very complex cryptographic scheme that intends to make all transactions effectively anonymous. And Bitcoin is not anonymous at all, only if you never reveal yourself, but nowadays this is quite difficult to do. And what are blockchain platforms? Blockchain platforms are cryptocurrencies platforms that have a blockchain for itself, such as Bitcoin. Not all do. Some are tokens that run on blockchain platforms. And what actions in essence is a platform for smart contracts that you can do pretty much whatever your creativity allows you to do so. Some examples are Ethereum, which has its currency, and it's called Ether, but we ended up calling Ethereum always. Solana, Binance Smart Chain, Cardano, and several others. Now, to better explain what blockchain platforms, or I'll use Ethereum as it is the main one and has a market cap today that equals or actually surpasses a bit the 10 biggest US banks. And Ethereum is often seen as a world computer or the Ethereum virtual machine. Why is that? Because every node that runs a Ethereum network or Ethereum node, and this computer here I have dedicated to running nodes, it is one node or one peer in the network, and it's running every single smart contract. So whenever you go there and you buy an NFT, or you deploy a smart contract, or you buy a cryptocurrency in the Ethereum network, you are sending a smart contract, a scripting language, programming language that says, if this, then that. And this is simultaneously happening in every single over 5,000, I believe, nodes of the Ethereum network throughout the world. They are processing this same program in order to verify and validate it in the blockchain within consensus. Ethereum is also seen as a programmable money or a financial system in its entirety. As I previously said it, everything in a few years, perhaps decades, will be on a blockchain. The stock market, bonds, futures, commodity trading, and so forth. And all of this is made possible via smart contracts, which we will talk later on, but in essence means the possibility for us to create simple computer programs that execute functions that we want. And that may be the creation of 10,000 NFTs, and that the royalties will go to X, Y, Z, or the creation of a bet. If PSG wins tomorrow, then a certain amount of ETH will come out of my wallet to yours, and virtually pretty much anything. And on the Ethereum network, that happens through three main types of protocols. They are the ERC20 tokens. So Doge no. USDT, PNK from Claros, which some of you may know, they all run in as ERC20 smart contracts. They are smart contracts within the Ethereum network that create tokens. So there's a distinction, not necessarily widely adopted, but you may see it out there, that cryptocurrencies are only those crypto that have their own blockchain. Bitcoin, Ether from Ethereum, but those that are created as a second layer token within a blockchain are called tokens. Yes, Juliette, have you raised your hand?
Yeah, I have a question. So the ERC20 or ERC20 or ERC7021, are they like a template of a code of a smart contract? What do they refer to exactly?
ERC stands for Ethereum request for comment, and after it, there is so as it is decentralized, there is no single authority saying, oh, we're going to upgrade the blockchain to make a new type of smart contract. No, it happens slowly via exchange of information. So whenever someone has an idea, such as myself, that I obviously have no development relevance on this world, but let's say I have an idea, I go there and I call for an Ethereum request for comment that later on may become a EIP, that is an Ethereum improvement protocol. So actually it's not ERC20, it is EIP, but everyone calls ERC. And what in essence means is a proposal for an added function, but proposal to add a function to the Ethereum blockchain. Now, once this proposal is accepted, it goes into the source code, and what that essentially means, and now I believe that actually answering your question is ERC20, 721, 1155, they call for different types of programs within the Ethereum blockchain that will interact in a different way. So if I go there and I write a smart contract, and I will show you later how a smart contract is, I have to, in the beginning, that actually can be, it doesn't have to be in the beginning, but I have to write, this contract is ERC 721, or this contract is ERC 20, because as I do that, it will, in some complex, using complex algorithms, call for functions that are related only to that type of contract. So ERC 20 are only for creating fungible tokens. ERC 721, creating non-fungible tokens, NFTs, as we know it. And ERC 1155 can do both of these, and is more recently used mainly for gaming, in which you need the in-game currency, the NFTs, and to be able to trade, exchange, create new NFTs as you go on and so forth. Now, oracles. Oracle is something that I believe that have not had that much impact so far because of its complexity and issue with reliability. But it is something that I believe that we as lawyers will face a lot in the future. Now, the blockchain cannot see outside of the world. It only sees what happens in the blockchain. But if you want it to reflect the financial system, you need for it to be able to see the results of a game, the price of the dollar, of Apple stock, and so forth. So how do you get that information into the blockchain to solve a smart contracts function, such as who wins that bet? Via oracles. Oracles can be either a human, such as I myself go there and I put the result, but I'm biased to it as I may have interest. Or it can be via a smart contract that pushes information out of the internet, or the ideal fashion is via a decentralized oracle, such as Chainlink, which is another cryptocurrency that has, let's say, a number of oracles, and they stake their cryptocurrency in order to be able to be an oracle for your smart contract. And what this in essence means is, think of it, I'm going to make a bet with all of you on who is going to win the game tomorrow. And in order to have a trusted authority to decide to input the result, but also to not really rely on trust, because we rather rely on cryptographic proof, and this is a bad aspect of oracles. We decentralized it by making 20 oracles that they will invest money in our result. If they provide a correct answer, they will get a reward for it. If they provide an incorrect answer, they will be punished by it, by losing all of the money that they have staked. And this, in essence, is a game theory-like mechanism to ensure correct functioning of smart contracts. Stablecoins are a type of cryptocurrency that are used to avoid the volatility of cryptocurrencies such as Bitcoin and Ether. And there are two types: centralized ones, such as USDT and USDT, that rely on companies behind them that go there, buy dollar and store supposedly in banks. And decentralized ones, such as DAI and UST, they are cryptocurrencies which use a very complex algorithm, arbitration algorithm, to overfund their dollars by buying several different types of cryptocurrencies. So DAI is backed, I'm not sure of the amounts, but something like for every $1 DAI, there is the relevant amount of 60 cents in Bitcoin, 40 in Ether, another 30 in another crypto, and I think 50%, 15% on USDC. So it's not really decentralized. Now, utility tokens. Utility tokens can be any of the previous tokens. Some are focused on utility, some focused on other things and have utility. And what it actually, in essence, means is, it is a token that has an added utility to it. Whichever you want to add as an utility, you can. So a few examples are the CRO token from the crypto.com exchange. With that token, you have the right to have a credit card, pay things in other countries using the CRO token, get rewards for it, cash back, as well as discount in Netflix, Spotify, Airbnb, and so forth. PNKey from Claros, for those who are aware of it. By staking, essentially locking my PNKey, I can be eligible as a juror in their arbitrations. BNB from Binance Smart Chain, I get a discount in the exchange. Ape from Bored Apes. I'm not sure what are the utilities, but I know they are claiming to have some. And CBDCs. Well, this is perhaps the most important part of this presentation. CBDCs are not a cryptocurrency. They are not on a blockchain, and they are not decentralized. And CBDCs are essentially the worst thing that can happen to any single one of us. And it is the exact opposite of what cryptocurrencies are. As CBDCs, they only increase. I don't think I have said it. CBDCs are central bank digital currencies, but they run on a centralized system of the bank and of the central bank or the government, and it only amplifies the power that the government has on us. And it only goes against every single thing that Bitcoin and other crypto tries to avoid, that is political influence and monetary policy by governments that do things out of their own interest whenever they want to get more votes and so forth. So that would allow governments to essentially apply monetary policy directly to our accounts, and they would be the custodians of our money. There would not even be banks. Of course, they would come up with some different scheme, but our money would be within the central bank that will have direct access. Taxes would be charged directly, calculated directly. Would be really the worst case scenario for all of us. So if any of you one day get into a position of helping or working on this project, this is only my personal view, of course, but I urge you to try to not indulge the idea of CBDCs. Now, DeFi, which stands for decentralized finance. And only these three first parts are going to be a bit longer, then it will be a bit faster, okay? Decentralized finance stands for everything that we do today with internet banking and finance as a whole that can simply happen on a blockchain. And that all of that happens through smart contracts. I've put here a few examples of DeFi protocols, DeFi investments that that exist nowadays. So one of them are DEX. DEX is a decentralized exchange, as opposed to Binance, which is a centralized one, and there's a company behind and so forth. A DEX may have a company behind, but in essence, the trading occurs on-chain, as opposed to centralized exchanges that the trading occurs off-chain. And by occurring on-chain, it is quite a lot more anonymous, but it will incur more costs, especially if it is on the Ethereum network. There's also possibility to have bonds or to stake. Stake means to lock your coin for some purpose. For proof of stake blockchains, staking means to lock your coins so that they can be used by the miners, or you can be a miner yourself, to validate. And if you validate transactions, you get a reward for it. And there's also possibility to stake coins or NFTs for games. In some, you may do a complex scheme of lending your NFT for other people to play and so forth, and receive rewards over it. There are all sorts of different interest rates for that. They go from 1% a year to 400 or even 4,000% a year. But of course, those who have this gigantic interest rate will usually follow a decrease in the value of the token itself, kind of balancing the return. There's also possibility for lending, and this occurs mostly on-chain. So I go there and I lend 1 Bitcoin, and I get in exchange 10 Ether, and I can use this Ether as I want. And if I don't turn it back to the smart contract in X number of days, they will abate proportionally the amount of Bitcoin. You can set whatever terms you may like. There's also possibility of funding, and this is happening a lot, at least since 2017. And it is something that I believe that we as lawyers, if we are not working already, will someday work with it, or at least invest it personally. And funding can work in several different ways. And And essentially, in the end of the day, all of them are ICOs. There is initial coin offering similar to an IPO in the stock market. And ICOs got a bad connotation after the 2017 bubble, but they are a very good, really very good and interesting way for you to get funded. And this can work from an artist that wants to anticipate its resale royalty rights, or a startup that wants angel investors, or a venture capital, private equity, or even stock private traded company, but publicly traded company. And that can happen via ICO, IEO, which is an ICO that happens through an exchange such as Binance, which supposedly would have to make a due diligence of that coin. IFO, that is initial farming offering. IDO, that is, if I'm not mistaken, it is an initial coin offering via a decentralized exchange, or the initial coin offering of a decentralized exchange such as Uniswap. And IGO, which is initial game offering coin of a game. And DAOs. Now, DAOs are decentralized autonomous organizations. And what this is a way to administer one of these companies that I have previously said it. We are a DAO. However, we are an off-chain DAO in the sense that we are not on the blockchain. We do not have a token, and our voting occurs via thumbs up, thumbs down in Discord instead of via on-chain signing with our wallets. And DAOs is essentially any company or group that wants to be decentralized and regulated by the majority of votes. There's also the possibility of insurance. Now, nowadays, insurance is most widely used for on-chain solutions. So let's say you, for instance, just a question, is my camera like synced all right? Okay, thanks. For on-chain solutions, so let's say I'm going to invest something in a smart contract that is quite risky, so I want to get insured against it, guaranteed against it. So I go there and I hire some insurance. If that smart contract was badly written, there's an error in its execution due to a badly or poorly written code, I'll get refund somehow. And only now there are some growing use cases of on-chain insurance for off-chain purposes. The only one that I found that is quite a lot relevant to bring here as an example is one that I think it is in Nigeria, and some farmers which don't have a lot of capital, so they don't have access to traditional financing, they have made a smart contract for insurance that if their farms are affected by excessive natural events such as, I don't know, rain, earthquakes, and so forth, they would get refunded. Yes, Rosemont has said in the chat that they have that in Nigeria. If you want to add something to it, please, it would be nice to do so. And this is a real use case of real world on-chain insurance for off-chain purposes. And here's are some screenshots. I apologize for it being Portuguese, but I think it shows you the idea that I can go there in Binance and I can stake the X Infinity coin for 95% return a year. I can go there and do an automatic investment, put my coins in a liquidity farm, earn interest, have a savings account, participate in a mining pool, lend crypto, staking, do investment. There is some more complex scheme of investment, and so forth. And Launchpad, it's where there are new projects, new ICOs, if I'm not mistaken. Now, blockchain. Blockchain, this will be the most technical part of this presentation. And you may have heard a lot about blockchain in the past, in the sense that crypto is bad, but they come up with something great that is blockchain, and we will use blockchain forever for everything. But blockchains actually have quite a limited scope. Blockchains are not a database. If someday someone goes to you with a project saying, I have a blockchain, and you can get that phrase and change the world, with the word blockchain for database without changing the meaning of the phrase, then that is not a blockchain. A blockchain is a distributed ledger or messaging that are stored on this ledger technology that works in a append-only log manner, that is a chain of blocks. So data is only added to it in blocks with timestamps and digital signatures, and you cannot alter the content of previous data. It is also public in the sense that anyone can go there and check, verify, analyze what is going on, what is your account balance, the account balance of others, and so forth. It is also decentralized in the sense that there is no trusted central authority or centralized framework, such as the computer from the bank or so forth, deciding what goes on that chain of blocks or not. It is rather decentralized. So this node that I'm running here is one of these nodes, let's say one of these computers here, validating the network. It is also open in the sense that anyone, even me in South Brazil, can be one of these validators without permission. All I need is internet connection and a computer. Even a Node Mac manages to do so. This is also called as permissionless. And it also works via consensus. Yes, Dosia, later on I will gladly elaborate a bit more on CBDCs. All that also happens via consensus. That means that the decisions on which blocks are added to the chain of blocks are made via 51% or more of this distributed system. Now, to ensure that the majority takes the correct, the honest decision instead of compromising the network, there is also an incentive mechanism, game theory-like, that often uses a native token, such as Bitcoin for the Bitcoin protocol, Ether for the Ethereum network, that whenever you validate correctly, you receive it as a form of reward. If you validate incorrectly, you may be punished in ways we will address a bit later on. And it is also considered to be censorship resistance, in the sense that no government, anyone can go there and block it and stop it from being transmitted and broadcasted. I don't know if in your countries there are some cases similar to it, but in Brazil, sometimes the courts block WhatsApp or Telegram. Not that frequently, happen only 3 times, something like that, but that could not happen to blockchain. And is also considered to be hack-proof for reasons which I will elaborate now. There are a few important concepts to blockchains, and such as cryptography, nodes, mining, proof of work, stake, and hack-proof. This is perhaps a little bit too much for many of you that are not really aware of how blockchain works, Bitcoin and so forth, but it is really, really important to get around these subjects as well. They are called, after all, cryptocurrencies, and they are based on cryptocurrencies, on cryptography. So let's get into that a little bit. I'll open a tab here, and there are 2 main types of cryptography. One is called encryption. That is the one that we probably use daily in our cell phones, that they are encrypted via a password. In WhatsApp, they are peer-to-peer encryption. And what this essentially means is I have a key. With that key, I can read the messages that are hidden via code. But there's no encryption in blockchain. Rather, blockchains are only use asymmetrical cryptography, which means is that you get any amount of content in one side, and you pass to a future of this asymmetric or one-way algorithm, cryptography algorithm, and it will also result in a fixed length string of data that is completely random, and you cannot go back. It is not impossible, but it is rather infeasible, as they are, depending on the algorithm, 10 to the 77th possibilities, which is pretty much the number of atoms in the visible universe of possible attempts. So it is not subjectable to brute force. And to show a little bit of how that works, I will mirror the screen here. So are you guys seeing the Safari? Yeah. One, this is the ending. So if you go and you enter the same website in your computer and you enter the number 1, you can check that this cryptographic scheme, the result, the string, is the same one as I have here before. So you cannot use it to revert, as it is infeasible, but you can use it to check if 1 is really 1. And you can do this with a movie, with absolutely any amount of data. And if I go there and I change 1 single byte of information, the code changes pretty much completely. So this can be used to verify if the archives are correct or not. And this is used in the blockchain. And now turning back to the presentation and how cryptography works in a blockchain is to try to put simply in the following manner. You get any random 256 bits of data. There are 256 digits, ones or zeros. It can be done by flipping a coin, and that is a random number. You get this random number, you put it to the SHA-256 algorithm, and it will end up in a 67 string character of random numbers. This is your private key. If you want to make it even harder to break, you can add a seed extension. Some wallets allow you to do so, and that will virtually turn your 256 bits private key into a 512-bit private key, which is even less brute forceable. The possibilities of brute forcing it are 1 to 10 to the 180th. So it's like bizarrely big number. And how that works is your private key with your seed extension will go through 2048 times again, hashing via the SHA-256 algorithm. And now you have your private key even more securely made. After that, you get your private key and you pass it via another filter of algorithm called elliptical curve algorithm that will essentially get your private key, multiply it by X and Y in a graph, and the result will be your public key. Now, you cannot divide this by some complex mathematical reasons, but you cannot divide it. And you have your public key. And that is what happens today when we sign digitally documents. But that is applied in blockchains as well. And how are addresses created? Well, once you have the public key, you get something called derivation paths. The best derivation paths are those called hierarchical derivation paths, or HD, which will create from your public key a almost infinite numbers. The possibilities are 4 billion times 4 billion times 4 billion of public keys, so, or addresses. And these addresses, after they are created by the blockchain algorithm, they are going to be hashed again by another hashing algorithm that I always forget the name, but it starts with an R. It's like Rekip them, something like that. They'll make it a bit shorter so that it can be easier for us to read. And that will be your Bitcoin wallet address. Ethereum and others use a similar protocol, only the second part changes, the part of creating the address, but pretty much all use the same thing. And you may ask, okay, but how does the 12th word seed phrase is created? You get the 256 private key, and there's a dictionary called BIP39 that stands for Bitcoin Improvement Protocol 39. You can search on the web. It has 2048 words. Back then, someone went there and make a correspondence between every possibility of bits with every word. So each word stands for 11 bits. And what they do is this correlation and each word will correspond to a certain group of bits, and you'll to make it easier to store, because it is really difficult to remember F, Y, Z, K, but it's easier to remember the words. And once, just to conclude, addresses are created, all of what happens on blockchains, and that would take quite a while more to explain, so I'll just leave it there, but everything kind of works with hashes. You don't see not even addresses sometimes on a blockchain, rather you see the transaction hash that was a hash of the transaction input and output between both wallets, and the amount that was exchanged. There were also hashed, and everything is hashed. How nodes work? Nodes are the peers of a peer-to-peer network. So whenever you are at your place and you send a transaction via your wallet, this transaction will go to a node. It can be very well my node, probably not. It will very likely be the node that you choose if you have a wallet app that allows you to do so, or the node of the wallet provider that you use, or the node of the exchange that you use, that it will usually run nodes themselves. This node, there will be any one of these, there are over 10,000 in the Bitcoin network, will broadcast the message to all of the other over 10,000 nodes. And essentially, this is how the network works. There are three types of nodes: full nodes, that they have a complete history of the blockchain, and they are used to validate transactions; pruned, or nodes that only have a more recent database of the blockchain. Bitcoin's blockchain has 420 gigabytes, Ethereum's almost 1 terabyte. So it's not every computer that can literally store the entire node. And there are also mining nodes. And here's quite an interesting image of a blockchain header. And here is how mining works. Whenever these nodes get these transactions, okay, some of them are mining nodes. When a mining node, get one step back, this is hard to explain. Let's say that the previous block just got mined, okay? Every transaction that is happening now is going to the blockchain, to the network, and it goes into something called mempool, or memory pool. That is a memory of all the transactions that are pending to be inserted in the blockchain. What this will happen is the following. The miners, once the previous block is mined, the mempool will close and all new transactions will start to go to the next block. And what they will do is the following. They will get this mempool and they'll hash it, hash each transaction in a tree-like manner that will create something called a Merkle root, which is a hash of all of the hashes of all of the hashes of all of the transactions. They'll get the number of the version of the software, the time in something way that is a way to count times with seconds, the number of the nonce, which is the most important one here, the difficulty of mining of the time, and the hash of the previous block. What they will do is the following. Everyone says to you that there is a very complex mathematical equation. It's rather a very simple mathematical equation. They will get the block header that is made out of everything that I've pointed out with these, arrows, and they will change only one value, the nonce. And nonce stands for a number that only happens once. Remember of the algorithm that I showed to you on the screen, that it changes? So they have to hash it simultaneously, billions and billions and trillions of times, until it reaches the difficulty standard set by the network protocol, which is set automatically. So if it is random, you would agree that the hash can sometimes have 1 0 before, or 2 or 3 or 40 zeros, correct? But it is very difficult to find a hash that has so many zeros before. And what the miners do is they get the block header, which is a fixed data, and they hash it non-stop, changing only one data, that is the nonce, until they find a hash that complies with the difficulty standard that currently I think it's 17 zeros before the rest of the numbers. And this takes, in average, 10 minutes. And whenever the computing power exceeds the capability of doing that in less than 10 minutes, the network adjusts itself to make it a little bit harder, and so on. That is what mining do. And what mining serves the purposes of is to protect the network. Don't think of miners as, oh, it's that bad guy, the ones with the pistol, has a big farming mining farm, and just wants our money, create Bitcoin, and so forth. No, it is protecting the network in the event that something happens. And how the consensus work. Someone posted a very interesting post a few days ago, I don't recall the name, about consensus and voting, and how voting works, at least in blockchain of Bitcoin in Ethereum, is not necessarily by clicking a button. Perhaps some blockchain has this function, but in most blockchains, it occurs by just continue to stream. So if I continue to try to mine a block after the previous block, it means that I have voted for that block to be added to the longest string of blocks, longest chain of blocks. If I don't mine a previous block and I try to mine a competing block, then I have not voted against it. And this has several other technical and interesting implications that I can elaborate further on if any of you are interested. And pretty much to conclude, blockchain, there are proof of work blockchains and proof of stake blockchains. What they mean is the following. You get in proof of work, you mine, that is creating coins and getting transactions fees and validating transactions by using extraneous resources such as CPU power and energy. Proof of stake, you use intrinsic resources. You still validate them, but you only have to use the intrinsic resources, which are native tokens. So in ETH 2.0, that is about to come, a proof of stake Ethereum blockchain, you have to have 32 ETH in order to be able to be one of these validators. So all of these reasons that I have previously presented make it so that the blockchain is hack-proof, censorship resistant, and borderless. Now, going to the more practical aspects of the presentation. What are NFTs? The definition of it, I believe, can be put as a string of data in a blockchain that can grant you ownership of a digital asset and or of a physical asset and or a right. Some technicalities, storage is usually made off chain. So due to the fact that blockchains are heavy, time consuming, energy consuming, it is quite difficult and not really interesting for you to be able to make the storage of all of the NFTs on chain. So they are usually made off chain, often and ideally in off-chain storages such as IPFS, that stands for International Interplanetary File System. And the rules of how the NFT works, so what you got as in return for your investment, such as perhaps the utility of that NFT, how you can sell it, when you can mint it, and so forth, is all set by the smart contract. However, there's a very complicated aspect to it that is quite relevant for us lawyers, that quite often, and by often I really do mean 99.9% of times, associate terms of sale, when they exist, they are off-chain. So they are either in the website or the Discord group and not in the smart contract itself, which can raise serious questions as to its enforceability. There are often arbitration clauses, arbitration agreements, but they are not on the smart contract, rather in associate terms of sale. They are outside. Well, some types, yes, Juliette?
Yeah, so Bernardo, how are they connected, the associate terms of sales you said maybe on the Discord, how are they linked to the smart contract?
They are not at all. It's just, let's say that we create a token, the MetaverseLegal DAO, and in the smart contract, you can go there and buy. But in our Discord or in our Twitter or on the OpenSea page, there's a link to the associate terms of sale. Some may read, some may not read, but in the end of the day, you cannot prove that someone read that and had access to it, much less agreed to it, if it is not in the smart contract. Some solution that some projects made is to insert a link in the smart contract of the associate terms of sale. However, these links usually are in a centralized database, such as Adidas on site. I don't trust Adidas to not change the terms of sale after I have signed the smart contract. So what I've done to kind of propose a solution to it, I've written an article on NFTs legal issues and published it as an NFT. And I've made all of the associate terms of sale, even the licensing agreement for anyone who wants to buy it, to have a license for the author's rights. And it is everything on the smart contract. So it was just a fun way of showing in practice how this could be solved. But the problem is that, at least in the Ethereum network, it is quite expensive to write things on the smart contract. So if I wanted to write, literally type the terms in the smart contract, that would increase the cost of deploying the smart contract in around $500 US. I didn't want to expend all of that just to add 30 lines of contract. So what I did is I stored the contract hashed in IPFS, which is the high standard set by the community today as a reliable source of data, of storage. And IPFS essentially works as a Google Drive that works via BitTorrent. You know, this computer also runs an IPFS node that is transmitting and broadcasting files that I don't even know to all the network, making it more secure and broadly adopted. Now, if I have answered your question, moving to the types and applications of NFTs, they're pretty much everything. But the main ones today, or they may come in the future, are art, which have a benefit for artists, as it is a way to ensure that they get the royalty resale, royalty right that is provided by 80 or more jurisdictions throughout the world, such as France and Brazil. And it is also a way to sell and launch collectibles and sports NFTs, and also streaming. And by streaming, I refer to music, movies, and books, even though books don't work exactly via streaming. But in coming years, the next Netflix would be a Netflix NFT that will be to Netflix what Netflix was to Blockbuster. And it also applies to games. In-game assets nowadays are going to be even more. There are some that they'll be adopted as time passes as NFTs, so we can change, we can exchange, we can try to profit out of it. Instead of buying, for instance, the CD to be able to play the game, I'll buy the NFT that will give me access to the game. If I don't like it, I sell it. There are also utility NFTs that virtually can apply to every single thing in the world, and mostly to commerce. So we'll see that there exists already, but there'll come more NFTs in which I'll have access passes for VIP rooms in airports, for discounts in the pizza or coffee shop, and also for eventually even participating in the profits of a company, which also already exists. And digital twins. And digital twins are NFTs that represent a physical object, but in the metaverse or virtually. Digital twins are also applicable to pretty much anything. As Mark Zuckerberg said, when we go to the metaverse, we are going to want to take our stuff. I'm going to want to take this and that because I like it, and we communicate through what we buy. And the metaverse is a way to amplify the way that we communicate ourselves. So in doing so, there are two types of digital twins. Those which may refer to assets. They are both physical and digital. For instance, an apartment in Miami that is being constructed, and the firm is going to sell the apartment, physical one, which is going to be delivered next year, and also an NFT of this exact apartment in the sandbox game that will be correlated and attached to the property of the apartment. Or the digital twin NFT can be a digital certificate of ownership, such as also happened with an apartment, I think in Florida, in which the seller sold an NFT that had the property of an LLC that owned in turn the house in the registry of property. And these are things that we are going to see use cases that are going to grow over time. And what the UST creator, the stablecoin, said recently is that he believes in the next 10 years, every single commerce, even the coffee shop in the corner, are going to have NFTs, digital twins. Well, there is also the application of NFTs in the data industry. And this is really, really a breakthrough that will change our lives in so many ways that we're only starting to grasp. What the data industry does is essentially uses our data to make studies and profit out of it. So when we go to the doctor, we give him our data. He later on passes on this data to the big farm industries. And what they do is they use that data to 20 years later, launch a new product, but I won't receive anything for it, and I'll have to pay the same amount that my neighbor that didn't provide any data. With NFTs, data can be on-chain as NFTs. I can follow their use throughout the blockchain, authorize or not their use in some specific study, and profit out of it together with the big companies. And that also applies to finance and big techs that profit out of ads such as Google and Facebook. And it's quite interesting to see that happening now, only right after the EU and other countries have come up with the GDPR, and this completely changes entirely how the processing of data works. And also NFTs will apply to documents and registry, and from property registries, from houses and apartments, IDs, attendance, such as this event, and so forth, and to AI. Now, artificial intelligence does not exist so far, and it is not even near of becoming a real thing, perhaps in 50 or 100 years. What exists today, and everyone ends up calling artificial intelligence, is big data and machine learning, which is indeed a very complex algorithms working really hard with a lot of computational power to provide results that may not have been anticipated by the developer of that code. However, this is not artificial intelligence per se. That being said, there are several NFTs being created with artificial intelligence to serve as bots that will solve problems such as when you enter a website, or as bots that will process images and even create art that is really beautiful after processing it hundreds and hundreds of times via the artificial intelligence algorithm, which may raise an interesting question that is actually already being raised on the property of the IP rights of that art. Smart contract. Now, this is the area in which I believe that we all here as lawyers may end up working not only for on-chain solutions, but also for off-chain solutions. Now, very briefly, a contract can be described as a promise or performance. Here is promise of performance. I'm sorry, it's or. Promise or performance given in exchange for a promise or performance. Smart contracts focus on this: performance given in exchange for performance. If this, then that. So if I go in the vending machine, I put $1, a soda pops out. That is a smart contract for a physical example. And that is what happens on an NFT. I send Ether to you, in your wallet sends me the NFT. This ends up avoiding many issues from raising, discussions from raising. However, there are some promises which may happen also in smart contracts. Now, this slides here I grabbed from Professor Larry Lessig, which had this great idea of showing and writing this. And he stated that smart contracts only apply to performance given in exchange for performance, I do believe that they may also apply for promises given in exchange for performance or promises, in such a way that when I launch an NFT that I promise to give royalty resale rights, although it is all executed automatically, it is a promise that a future event will happen and that I will perform if that promise of future event happens. So some interesting aspects to reflect on smart contracts today that happen on chain, and they are essentially being drafted by developers instead of being drafted by lawyers. So here's the question of whether or not we are going to somehow enter this world having to learn how to code or having to learn a new language and so forth. And honestly, I really do believe that in following years and decades tops, it will be mandatory, so to speak. Now, this is an example of smart contract. You can find it on the link above. This is the code. It has over 1,000 lines, really complicated. And here you can check and verify every single thing that is written in there. Here is the function to read the contract. I can go there and, for instance, go to the option owner of. I put the number of the token, 9,055, hit query, and it shows me the address that owns that NFT. And if I want to see that NFT, I go to the token URI function, I insert the token, and it shows me the link, or better yet, the URI, which is unique resource identifier for the IPFS, which is that decentralized storage file system. And I go and I search that on the web, and it shows me this. This is the NFT metadata. It is written in JSON language to be able to be grabbed by marketplaces in an easier way, and for them to reflect these data automatically in their platform. So when you go to OpenSea, you see that there are the characteristics, description of the NFT that is not written on OpenSale. That rather is written here, and OpenSale just brings that automatically by reading this, including the image, which is this. I get this hash here, exchange, and it shows me the image, which is Eminem's NFT. So as said, the NFT is not the data itself, it is not the image itself, but rather it is some type of certificate or a string of characters in a blockchain that will lead to the ownership of the digital or eventually physical asset or right. And you also have the ability to write or execute smart contracts on chain. That is done so by using the option write contract. You go there and you approve the sale, you mint an NFT, or you make a transfer from one address to the other. Now, you may have seen that there's no option here to auction or to pay an amount for a sale. I can only transfer here. The reason for that is because this contract, the way it was written, it does not provide for auction nor for sale for a price. And that is because quite often, and honestly, I have never seen a contract that provides for both, auction contracts are made separately. So when you're going to get an NFT and sell it on OpenSea, you're going to either create it through the OpenSea smart contract, or you will deploy a smart contract by yourself, and later on you will sign a transaction with OpenSea with their contract, which can interact with yours. And I think I forgot to say it previously, but smart contracts can interact between themselves as well. And this is actually a great thing, but also a problem that has ended up being the reason for many schemes and lost funds before. This is present, but in the future, I really do believe that smart contracts are going to be used by us lawyers and entrepreneurs as both an on and off-chain solution. So even the simplest purchase and sales agreement to a more complicated scheme of purchasing and sales, we will perhaps make part of it or all of it in smart contracts. I don't know if in the Ethereum network or in another one, but as it really amplifies the possibilities and auto performance, it simply seems to be the future. Now, DAOs. DAOs stand for Decentralized Autonomous Organizations, which in essence means any organization, company or not, that is decentralized and one stock equals, as an IPO, let's say, a publicly traded company, one stock equals to one token. Now, the rules of how this decentralized autonomous organization runs are set in the smart contract. You may make it very simple and the rest is discussed in Discord, or may try to make it really complex. Nowadays, there are no great complexity to it. It is often set only by rules of majority and so forth, which is the wallet that has the power to make the purchases or sales, if it is the case, and so forth. And decisions can be made on or off chain due to the costs that are incurred in making an on-chain decision. Perhaps a simple signing on a blockchain transaction may cost $15 or $50 or $100 if the chain is really loaded. So it will not make sense for the 50 or 150 of us to go there and pay $15 each for something that may not have a financial benefit proportionate to it. So they're usually done in an off-chain platform such as this snapshot.org. And decisions can be made by the majority or whichever proportion you set in the smart contract. And the main types of applications are investment funds, charity funds, funding, and this literally funding for absolutely anything whatsoever, and for any company or group. Nowadays, applications are indeed for more on-chain purposes, and I do not have a perfect example of off-chain solutions or off-chain examples, but it will come within a few months or years, I believe.
Isn't a group MetaverseLegal an example of an off-chain DAO?
Oh, yes, it is. But what I meant by off-chain DAO is like, let's say that Sony or Apple or the next Netflix that has off-chain products or services to run on-chain. There was this clarification to be made, but indeed. So far, there's no like real company that has real product that everyone around the world knows, services, real world that is on-chain. At least I don't know of any. This is an example of an NFT that I own, and this is not an investment suggestion. Even in the last 3 months, it dropped in price for about a third. And it's quite an interesting case because the creator of this NFT has like, I think 17 years. It has an arbitration agreement as associate terms of sale that is most definitely pathological. And here is the process that I've made after I bought it. This is called head down. So I have the NFT, and having the NFT allows me to participate in the DAO of this group. And this DAO, what they do is they buy blue chip NFTs such as CryptoPunks, Bored Apes, and sometimes they may sell with profit or whatever the group decides to do. And when there are funds and we have funds to spend, they send a link on Discord and we go into Snapshot to vote. So here's an example: January 8th purchase to see if we were going to buy or not the Mutant Ape Yacht Club to have a 372 and so forth. And here in this other screen, it shows how the staking occurs. I get my NFT, I stake it, lock it in a smart contract protocol, and in exchange, daily, I will receive tokens of the DAO. So it's not that the NFT itself is a pass or a stock of the DAO, but rather having the NFT and necessarily staking it will give me the right to daily receive a few tokens of that DAO and further increase my participation on it. This raises quite a lot of different interesting questions, legally speaking, on whether or not this is a security, because the NFT itself may not be, but the DAO may be. It is really, really an interesting subject. dApps. Now, dApps is pretty much a decentralized app, and there's no mystery to it. It happens pretty much as apps as we use it today work. App that I have here in my cell phone, the Zoom app that we have, how do they work? I get it. I have the interface, which is an app from the App Store, and I interact exchanging informations. And there is an internet service provider that is centralized that makes this exchange of informations with the database, centralized database such as Amazon Web Service. Now, dApps is pretty much the same thing. The end user, such as me and you, cannot technically, theoretically, distinguish the Spotify app from the Spotify NFT app, which may very well be an app downloaded in App Store. The difference is that the decentralized app, instead of interacting with a centralized internet service provider that by in turn interacts with data center, it will interact with decentralized internet service providers, which, although doesn't appear on this image here that I grabbed from the internet, interacts with the blockchain. So some of these interactions of mine may create not changes in the state of the Amazon Web Service database, but rather, may create changes in the blockchain. That is the main relevance. And for that to be properly decentralized, it is not only for an app to be making some correlation with the blockchain, but rather an app whose interface would be developed as open source, that the internet service provider would be decentralized, that the storage would be decentralized, and the interaction would be with the blockchain. And these are two examples of dApps. OpenSea is a dApp because they have a user-friendly interface that does not necessarily need to be friendly, but it is a user app-like interface that interacts with the blockchain. So you remember that I showed the metadata that had the characteristics of the Eminem's NFT, gray, hip hop, closed, whatever. This all was pushed automatically from the NFT metadata. And here I have the contract address and so forth. This is merely an app that interacts with the blockchain. And Uniswap also is a dApp. And interestingly, a few days ago, I only had the headline, so I don't really know what happened, but someone stole some funds or did something correctly using Uniswap, I believe. And as a response to that, and as a response, I believe, to government pressure, Uniswap blocked a few addresses from using their protocol. However, they did not block these users from the smart contract because they cannot do so. There may technically be the possibility for them to do so if that possibility was already written on the smart contract, which I believe was not. But all they did was to block these wallets from interacting with the dApp, literally with the app on the browser. But if these users are tech savvy, they can go directly on the smart contract, either by using a node or using, for instance, Etherscan, which is a block explorer, to go there, interact directly with the smart contract, irrespective of whether or not the dApp may have blocked their access. And games play to earn. Now, every one of us has already played a game in which we have to pay for the CD, and we only play without getting anything in return. We only spend. And within a few years, these games became even better, and we purchased not only the CD, but also we purchased in-game assets. Sometimes we could sell these assets, sometimes we couldn't, sometimes we were obliged to sell the same price, sometimes we can try to sell it with a profit. And the revolution of this is P2E or play to earn games. That in essence is a game that is run either by a centralized company or by a DAO that shares its profits. And there are several ways for players to monetize whilst playing. The easier one is by buying the token itself, such as the token Sand from Sandbox or Mana from Decentraland. Of course, I'm susceptible to the risk of it depreciating in value, but I also may gain from its appreciation in value. There are also the possibility of buying and selling NFTs, such as Sandbox Land was sold around $200 in 2019, I believe, and now they are worth no less than $5,000 US. There's also a possibility that I forgot to put here to stake the NFT. So there are games, for instance, in which I can stake my NFT for other people to play, or which I can stake to receive tokens of the game. Several possibilities. It is within the game creator's creativity to develop it. And play to earn. Play to earn is quite a I don't want to say sensible, but controversial subject, in the sense that the player can be me. I have found out that I have 2 or 3 friends that they separate 1 hour per day to play X Infinity, because in the end of the month, they can make around 100 or 1,000 US dollars just by playing 1 hour a day. And how does that work? As long as you pass phases, or as long as you play the game, even if you don't win, you receive a proportionate reward in in-game tokens, such as AXS from X Infinity. And that has a value in the market that you can exchange for dollars, for Bitcoin, and so forth. There are some discussions on whether or not this would be a pyramid or Ponzi scheme. And my personal opinion is that it kind of depends. I have a client, a company, they are a developing company, programmers, and they had a client of theirs that wanted to launch a project that they were afraid if it was or not a pyramid scheme. And it was really difficult to analyze if it was it or not. And I asked them, programmers that work with NFT for quite a long time, specialize on that, are games play to earn a pyramid scheme? And they couldn't answer. It is really difficult to analyze it. So there are lots of people that say it is plant right, or it isn't. It depends. I believe that it depends. I personally don't have much knowledge of the token economics behind it, nor I play games that much. But I believe that it's going to be a very big discussion in the near future. And this is just an example of the X Infinity. In order to be able to play it, you have to buy 3 axes, which are these things here, the axes. And if you want to stop playing, you can sell it. Instead of buying the CD to play the video game, you buy the NFT, or you buy the token. That is quite an interesting approach, which I think that is here to come. It's here to stay. And this is just a screenshot of how it works. Now, the metaverse. The metaverse is perhaps a combination of all of that, or something that does not depend on none of that whatsoever. I personally believe that the metaverse in the upcoming months or years may not have as much impact as we may believe, due to technology issues. But in 50, 100, or 500 years, it will very likely be the doomsday of our society as we know it. Kind of a mix of Matrix with Total Recall, a movie from 2012 that I really recommend you all to watch. And what metaverse is a virtual platform that may or may not be accessible via VR. It can be browser related, which intends to bring a more real and world-like experience in a virtual setting that may or may not reflect the Earth as we know it, or maybe something completely different. There are 2 main types of metaverses: centralized and decentralized. Centralized are the metaverses that Facebook and Microsoft have created and are developing, and as well as Sandbox and Decentraland. The differences between these 4 is that Facebook and Microsoft, at least so far, have not adopted any type whatsoever of Web3 related technologies. There's no crypto, no NFT, none. Sandbox and Decentraland, on the other hand, they are private held companies, but they do interact with blockchain technology. They have tokens, they have NFTs, and so forth, but they are centralized. That means that the decisions on what happens to the game are made via their company. That is not necessarily a problem, but it's just the way that they work. There is also a decentralized metaverses. There would be a game, just as any other, in which you would be able to not only play as any other, or not necessarily a game, but whatever metaverse it is, but also you would be able to, with the tokens of the game, make decisions on what the game would do. And I'm not 100% sure, but I believe that Gala Games is decentralized in such a way that if I have the Gala token, I can vote on which projects to develop. And let's say that the founder, I don't want anymore to run this company. I'm tired of it. I'm rich. I don't want it anymore. The token holders can vote to decide to give continuity to the game, to elect a new CEO and so forth. And this is an interesting approach. Some types of metaverses are gaming, most common nowadays, entertainment, and by entertainment, I mean some that don't really exist so far, but in which you'll go someday to a nightclub, or I went to spend a week being 007, or I went to sleep with Giselle Bündchen. That will happen sooner or later. And this is precisely the metaverse that I believe that will be the doomsday of society, because it's going to be so good for us to be there that we are not going to be want to be on normal Earth anymore. And social and professional, which are both being developed and focused on by Facebook and Microsoft. This is just an example of the sandbox. Here's the Snoop Dogg party, a yacht that was sold, I don't recall, I believe 500 US dollars, the price of the land at the time that screenshot was taken, and the maximum market cap that the Sand token reached, which was about 7 billion US dollars. So it's quite a lot. Here another example of the Earth, the land in the central land. I believe that now it is a little bit cheaper. And an example of an experience within the Decentraland metaverse. And there's one thing that I forgot to mention, that in NFTs, in game or in metaverse NFTs, such as Sandbox, and I believe that the Decentraland as well, you can not only profit by selling NFTs, etc., but also by creating NFT. So even I, that don't know anything of design, can download an app called Voxel, which is relatively easy to use as long as you dedicate yourself to it, create NFTs, such as a t-shirt, a mannequin or whatever, and you sell it as your content. This can serve the purposes for companies, for content creators. It is really a flip in mindset on what the economy is related. So that is it. And my first question to you was, what were we doing in 1995? That is 27 years ago. So what will we be doing 27 years from now? Will things be even more different than they have changed in the past 27 years? I honestly think so. So it's a great opportunity for us, great minds from all around the world, being together here to exchange. I think it is a really, really nice opportunity that Katya has made possible to us by bringing us all together. And even if you don't like it or don't like it that much, well, we are still in 1995. There's still time to get around it and perhaps learn more about it, or create a company related to Web3, or act as a lawyer on it, as at least I myself am intending doing. I think that most of you as well. Thank you very much for the attention. It was really great to make this presentation with you all.